Many economists had expected inflation to reach that turning point. Do you think this is the turning point? Do you think we could still see some downside surprises going forward from here?
No, we do think it's the turning point. We think from here on out it's going to probably edge up slowly. It's not going to be anything dramatic that necessarily at this point will create any panic. But we do think the trough is behind us and it will slowly creep up. But it remains very contained. And I mean, the key factors there is moderating service inflation. As you know, services, they generally tend to set their increases based on past inflation, and with inflation coming down, that will probably remain contained for a time. For the time being anyway, and then also much lower import costs. So the strong rand is still a big factor there. Of course, the rand has taken a bit of a knock of recently, but nothing that would cause any great inflationary pressure, not even remotely. So at this point, everything still seems contained, but the actual number from that lower base will start to creep up.
So that's the lowest we're going to see, 3.2%.
I think so, yes.
So we won't be reaching 3%. I ask this because, Russell
She's determined that it should go below 3%.
ETM, no, it's quite an interesting, argument, basically, that we're going to see a stronger rand from here onwards, and of course that means we'll, see less imported inflation into the country, so therefore it could reach that key 3% level. Do you think that's a possibility, Nicky?
Well, there's nothing wrong with that argument. I mean, if the rand were to go like 650, 640, and we're at that sort of level again in the first half of next year, that certainly will bring prices all the way down. If at the same time you, however, find that demand still remains quite sluggish and retailers are still forced to continue with this heavy discounting, then clearly inflation is a non-issue. What we're saying, though, is yes, the rand is a factor and we expect it to remain firm, not quite at those sort of incredibly, aggressively strong levels. So just firm, so the big decline in the rand, that effect is out in the base already. And at the same time, you do now see demand starting to pick up a little bit. People are feeling a little bit more confident. They start to spend a little bit more. Retailers are not quite in that spot where they have to sacrifice that much margin. They don't have to discount that aggressively. And so slowly you see inflation creeping up. For us, at this point in the cycle, that seems a more plausible argument. But clearly, the rand is the unpredictable factor.
Well, taken together with the growth figures for the third quarter we saw yesterday, disappointing at 2.6% for the quarter. Looking forward to the next interest rate meeting, do you think there is a possibility we could have another cut, given the poor growth situation, even though inflation's turned the corner?
Well, I think that certainly when they announced or made the decision to cut rates in the November meeting, they had that number in mind. That number wasn't far off from our predictions. We had about 2.93%. And we saw that slow down, so they very clearly would have had very similar predictions. So I think that they'd largely already been discounted in the cut that came out in November. So I don't think that it adds any new information. Is there still downside risk to interest rates in the cycle? Yes, we think there is. I mean, if growth were to disappoint, Europe looks like it is in an incredibly fragile, precarious, dangerous place at this point. And Europe is a big export market for us that will affect us. So if things were to go badly wrong on that front, I think certainly they will be worried and they will consider cutting again. And if inflation just remains contained, you might see another cut. So growth is the key thing here. If it disappoints, I think they will cut
Nicky,
again.
growth above 3% for this year, do you think that's a possibility? Because that's what the IMF and government have been talking about for quite some time.
No, we don't. We think we're going to probably average about 2.8% this year. So that's more or less the number we've got. I think that's in line with what the
Reserve... sort of streamline into 2011.
Yeah, into 2011 we think 3%. We can make 3% in 2011. It will be a slightly stronger recovery, but still very, very modest.
And of course, we had the new growth plan outlined yesterday by Economic Development Minister Ibrahim Patel, talking about getting to a growth rate of between 4 and 7%, creating 5 million jobs over the next 10 years, looser monetary policy, competitive rand, and I think what else was he talking about? Wage cuts.
Right, wage cuts,
or
yeah.
No wage increases.
Wage restraint.
Wage restraint. What do you make of that, and how do you tie that into the Reserve Bank's mandate as it stands at the moment, and the growth that we're likely to reach over the next couple of years?
Yeah, well, I think certainly that particular aspect of the policy bothered the markets. They were not impressed by the notion that Treasury now sort of prescribes a sort of tendency to monetary policy. So how that will actually pan out in practice is difficult to say. When you read the document, there are some, it could go either way. They do acknowledge that there are times that interest rates need to be higher and other times that interest rates may be lower, making the point though that when you hit those sorts of circumstances, you should cut far more rapidly, and I think that is maybe a subtle jibe at the previous cycle more than anything else.
And what about the fact that, they talk about creating a sovereign wealth fund? Do you think that's a nice strategy to adopt? We know that Mauritius embarks on a very similar strategy in their budget, which was tabled about a week ago. Do you think that most emerging markets are going to be creating these sovereign wealth funds?
Well, I don't think it's a bad idea, but I think sovereign wealth funds in some way or the other is always related to export success, which to a large extent we don't have. We do have the resources, we do have the minerals, but we run a current account deficit. So how exactly that will be done, whether it would simply be related to the slow build-up of reserves and that this sort of fund will be deployed in a strategic fashion at times that you would like to manipulate your currency a little bit more, that's fine, but I don't think that we're going to be a China overnight. I think that will be a very long-term strategy if they're going to go about that. I think the main thing about the growth plan, if you look at the macro objectives, wanting to reduce unemployment, that is literally a no-brainer. That is a must. It is something that has to happen in South Africa over time. So, all the sort of macroeconomic objectives are fairly laudable. The only little bit of concern there is the reference to monetary policy and the fear that that creates around possible interference into the independence of the Reserve Bank and into the independence of their monetary policy decisions. Because nobody really wants to see runaway inflation 15, 20 years down the line. So that's the only little bit that is of a concern there. The rest is pretty laudable stuff, and I think we all strive for that. More rapid growth, a more competitive economy, much more rapid growth of employment. The worry here is when you break it down to the micro level, to how they actually aim to achieve it. Yeah. And you come to the conclusion...
a lot hinges are basically on wage restraints, as you alluded to.
Yes, and the wage restraint they refer to, they say for your lower income earners, they're going to have wage restraint. In other words, they're going to limit wage increases to inflation and a bit, right? Whatever that bit may be. But the point is that's above inflation increases. No tie-up to the specific skill, no tie-up to the contribution to the company, no tie-up at all to the level of productivity. So there's no performance element there.
Government interference in the private sector?
But we'll get to that. And then the other side, the point I will make, is for your higher income earners, which they deem to be 550,000 and above, there's going to be a wage freeze or a salary freeze, and they don't explain that. But here's your problem. Of the lower income earners, where you're giving an above inflation increase, essentially you have a surplus, right? And of the higher income earners, where you have the skill, which is what companies need to be competitive and come up with the good strategies and design the good products and drive the economy forward, you have a shortage.